Phil Town, Pat Dorsey, several other super investors are buying up ASML holding stock. In fact, we just found out last quarter Phil Town bought into this company. So I've been doing research on them, trying to figure out what does this company do? Do they have a competitive advantage? What does their history look like from a financial perspective? And then most importantly, what is the intrinsic valuation of AMSL Holding? We're going to do all that in this video here today. So first off, what does ASML Holding do? Well, they actually make equipment for the semiconductor space, and they basically make lithography equipment. This is a whole new arena for me digging into this and doing research. I'll put a link down below to a CNBC video that explains in depth what does ASML Holdings do. But in layman's terms, I'm going to say that they make lithography equipment that basically prints on chips or on wafers. So they actually produce light in this equipment that makes patterns on the chips at a minuscule rate. In fact, it's at like 30 thousandths of a hair. I mean, it is so fine, so precise, and it has taken them decades to get where they're at right now. In fact, it leads into, does this company have a moat or not? And they absolutely do. In fact, I have researched hundreds of companies over the years, and I got to say, this is one of the biggest moats I have seen, period, of any company. In fact, ASML Holdings has a monopoly when it comes to the EUV lithography equipment. Now, there's two types of lithography equipment that they make, but the EUV specifically, for my research, they're the only ones that actually do that and made it. And the reason for that, it's so expensive. So one machine that they sell to their clients is between $200 and $300 million, right? And so it's taken a long time and a lot of money to get to where ASML Holding is today. In fact, in the trailing 12 months, they have spent $4 billion. So over 25% of their revenue has gone into research and development. So it is really hard for companies that want to get into the space because ASML Holdings is so far ahead of them, and it costs so much, and they have such unique relationships with their clients and their suppliers both. In fact, they've actually bought out some of their suppliers, so they've been able to create this vertical integration too within the company. And they only have a few clients because their machines are so expensive. Companies like Intel, Micron, Taiwan Semiconductor. These are the companies that are buying these pieces of equipment from ASML. So, they don't sell a lot of machines, but they're very, very expensive. And this company is growing very, very quickly. And I believe the reason why Phil Town, Pat Dorsey, and these other guys are getting into this company is because of AI. And AI driven and going to the future is going to need chips. You're talking billions, trillions worth of chips. And these companies like Taiwan Semiconductor, Micron, Intel that are making all these chips, they need these pieces of equipment like this lithography equipment in order to get ahead of their competition and make their chips more efficient. And that's the key with ASML. They're trying to make their clients' processes and their chips more efficient down the road, because the companies that are actually using this down the road that are buying them from Taiwan Semiconductor stuff is NVIDIA, AMD. So it all starts at ASML Holdings with this equipment in order to get NVIDIA and AMD to where their chips are to put into computer equipment and servers and all that kind of stuff down the road. It all starts with ASML Holdings. So very, very unique overall. They have a monopoly and even an oligopoly in their other type of equipment as well too. So very, very unique space. Something also to keep in mind with ASML, these pieces of equipment are supposed to last a few decades. From my research, it looks like they can last around 30 years. But what's really neat and what's great for ASML is that they have service contracts in place to service these pieces of equipment because they're so unique, they're so precise. You just can't hire anyone or use your internal people to work on these equipment. So they have to use ASML to service these pieces of machinery. So not only are they selling this piece of equipment, but then they actually get service contracts as well, or built into the selling cost of the price of the machine. So they're creating recurring revenue for the company as well too. And these companies that are going to be holding them for 20, 30 years plus, this is a really long recurring service contract that they have with them. So that's another great way that the company is able to generate revenue from the machines that they're selling as well. And to put that recurring revenue in perspective, those lithography machines that ASML creates. So that EUV I was talking about before, the one prior to that they also make still today is DUV. That's where they have other competitors in that space as well. So it's kind of like an oligopoly type industry. The service contracts with that, for example, are about 130% of the original piece of equipment. So the EUV, which is the newer version of the lithography machines that they're making, are expected to have 150% type recurring revenue based on that first, equipment purchase. So what I'm saying there is that these new EUV pieces of machinery are probably going to have higher recurring revenue for their service contracts than the previous machines that they were making, which is going to be a huge benefit to ASML. So next up, let's take a look at a 10-year history financial perspective for ASML Holdings. We're first going to look at Phil Town Rule 1 numbers, and then we're going to get into some balance sheet and cash flow numbers as well. So let's go take a look at that right now. On your screen now, you can see the Rule 1 numbers, and you can see that their market cap has gone from $38 billion in 2015 all the way up to $257 billion here today. So this is a very, very large company. Their sales per share has grown 19% per year over the last 10 years. Earnings per share has grown 20% per year over the last 10 years, 19% for free cash flow, 9% for book value per share. Return on equity has averaged 34%. The return on invested capital has averaged 25%. So very interesting looking at those specific numbers, right? You're seeing massive growth, around 20% per year for earnings, sales per share, free cash flow, return on invested capital over 20%. Absolutely fantastic. What's interesting is that book value per share only being around 9% per year. So I looked into that, and what it is deferred revenue. And actually, this is a fantastic thing for a company. So if you see like deferred revenue or unearned revenue, for example, on the balance sheet, essentially what that means is that the company has received money up front for a service they haven't even provided. So think of your insurance carrier. So maybe you gave money to your insurance carrier for car insurance, right? You paid them 12 months in advance. That is deferred revenue or unearned revenue on their side because they haven't provided that service yet. So it goes onto their balance sheet as a liability. They owe that money still if you were to cancel your service or whatever. But they get that money up front. So it's a huge benefit for the company because they can go take that money. They could invest it if they wanted to. They could put it in research and development, whatever they want to, right? And so it's fantastic. I mean, a lot of SaaS companies, so SaaS companies, a lot of subscription-based companies, they have that same type of model, which is fantastic. So the reason why that book value per share is lagging those other ratios is because I believe it goes back to ASC 606. That changed in 2019. It's an accounting standard. I'm an accountant myself. I'm not going to get into what that standard is, but basically that is the reason why that book value per share looks lower. So I think it should be more in that 15 to 18% range if it had the same accounting standards back then than it is right now. I think that's what's affecting it. So I would not worry about that book value per share going down. Plus they've been buying back shares, which is going to affect that as well. So let's take a look at some other financial numbers for this company too over the last 10 years. So if you take a look at their debt, for example, the long-term debt payoff, it's only half a year. So it only takes about a half a year of their free cash flow to pay off all their debt, which is absolutely fantastic. Their debt to equity ratio is 21%, which is excellent. Their current ratio is 1.5, which has actually gone down a little bit, so that's working capital. But nonetheless, their balance sheet is in phenomenal shape. I will give this an A balance sheet overall. Now, if we look at some P&L ratios, their gross margin is 52%, and you can see it's grown over the years. It's gone from 45% to 52%, which is excellent. Also, what's excellent is their SG&A percentage has gone down. It's gone from 5% down to 4%. Meanwhile, their operating margins have increased from 30% all the way up to 34% over the last 10 years. Their PE on average over the last 10 years has been a 31. Right now, they're trading at a 24, and the company has bought back shares at a steady pace over the last 10 years. So I love seeing gross margin climb. So that is telling me that their costs it's taken to actually make their pieces of equipment and other products potentially are getting cheaper, or they're actually selling it at a higher price and getting that higher gross margin. So that's also affecting, also increasing operating margins as well. Not only that, but their SG&A is going down. So this is like a perfect trifecta of what's going on with the company. You're having gross margins go up, operating margins go up, and their SG&A is going down. So what that's telling us, and also looking at what analyst expectation is they believe operating margins are going to continue to climb going out into the future. So they did around 32% operating margin last year, and it's actually projected to go all the way up to 40% over the next several years because their SG&A doesn't have to go up the same rate as, say, their revenue goes up, which is fantastic overall. The question will be, is the research and development, is that going to taper off? Is that going to increase? That will certainly impact some of these numbers as well. But nonetheless, seeing those go up is fantastic, and having that, monopoly type play in their industry, they're able to charge a higher price anyway overall to their clients, and they're going to have to pay for it. It's got to be like reasonable enough so they can actually spend money and buy it. But there's not competition out there that they're really going against in this space from what I've seen, particularly when it comes to the EUV technology. Now, let's go look at an intrinsic valuation for the company. We're going to be running a couple of different models here, and then we'll get into what the fair value of the stock is and potentially maybe a good buy price on some of these assumptions we're going to take a look at. So let's go do that now. So the first model we're going to take a look at is my discounted operating earnings model. Last year, the company did $28 billion of revenue. I think that is going to increase to $32 billion in 2025, all the way up to $48 billion in 2029. So that is 11% growth per year. We saw that sales per share growth be around 20%. So I think it's going to be half of what it's been over the last 10 years. I do think the company is going to be buying back about 1% of their shares per year. That's pretty consistent where they've been over the last 10 years. So I think they're going to continue to do that. I also am going to go with what analysts thinking the company's going to do from an operating margin perspective, growing from 32% up to 40% over the next several years. So based on that, their operating earnings growth is going to be 18% per year. So I'm going to give a multiple of 36 on this particular stock, and then that comes out to $921 for the intrinsic share price based on these assumptions here. Next valuation we're going to be taking a look at is my margin of safety calculator. This is very similar to Phil Town's margin of safety calculator if you follow him. So I think a normalized operating earnings per share for the company is around a 23. I think they have around 18% growth, which we saw previously. Based on that, I get a target buy price of $670 here today, and the stock is trading at $744. Now, if we take a look at a 10 cap valuation for this company, I come with around a $9 billion free cash flow number for this company. I think they have tax provisions of around $1,100, interest payments of around $20 million. That comes out to about total owner's earnings of around $10 billion. Based on what I believe they're rebuying back for shares, I get an owner's earnings per share around 27. So a 10 cap valuation of $270 here today. Next up is the payback time calculator. So I believe, again, a good free cash flow number for the company is $9 billion. I think that can grow on 18% per year. So that comes out to a payback time of 11 years. And ideally, we want to see it at 8 years or less. So a quick valuation summary for ASML is this. So my discounted operating earnings model suggests $920 fair value for the stock. A 30% margin of safety would be a buy price of $645. Payback time suggests 436, 10 cap 270, margin of safety calculator suggests at $670. So again, the stock is trading at $744. So it's not with any of those buy prices, but it's not far off today. So there you have it. I believe the intrinsic value for the company is around $920. Again, a buy price for the stock would probably be, in my mind, between $650 and $700 for the stock. So it's really not that far off from today. If we look at Phil Town, for example, who bought in last quarter, it was below $700. In fact, it dropped all the way down to the low 600s during the quarter. So I'm sure that's when he scooped up the share. Same thing with Pat Dorsey as well. So it's not terribly far off from where they were at. And the stock at one point, not that long ago, less than a year ago, was trading well over $1,000. So keep in mind, though, tariff situations, the chip market, all that have a significant impact on ASML and all their clients and the future clients down the road. But certainly, if you believe that AI is going to grow, I certainly think it's going to grow. ASML Holdings might be a really, really good company to get into and hold as the AI growth goes into the future. So very, very interesting overall. Now, if you don't know how to value companies, that is extremely, extremely important. It's probably the most important thing when you're actually looking at companies, whether to buy or not. Obviously, there's other stuff to go involved. You need to know what they do. You need to look at management, financial history, all that stuff. But valuing a company is critical in order to get good returns and to beat the market long term. If you don't know how to do that, I do show you how to do that with a couple different models. And I showed some of those here in this video today, but I provide those models to you in Excel and I offer those down in my Patreon. So I'll put a link down below. If you want to check that out, you get access to those valuation models so you can go value companies yourself. I have a video explaining how to do that. You also get access to my Discord channel. You also get access to my Patreon, which I do provide or post exclusive content to Patreon as well. So I'd love to see you over there if that's something you would like. Thank you so much for watching. I really, really appreciate it. I'll catch you guys on the other side. Take care and God bless.